The World Bank says Kenya's economy is heading for its worst performance since the COVID-19 pandemic back in 2020. The East African nation's 2024 economic growth outlook was trimmed to 4.7% from 5% forecast back in June. Floods and anti-government protests are weighing on output, along with the government's push for fiscal consolidation through tighter spending. For more, let's bring in Bloomberg's Ondiro Oganga, who is joining us from Kigali. So, Ondiro, how is this report highlighting Kenya's economy after what we know has been a really difficult year for the government there?
Absolutely, Jim. There are a couple of things that the government has tried to do so that they can get it right. One, inflation is down to 2.8%, which is within the central bank target range. Then the currency appreciated 20% against the dollar, making it one of the best currencies in emerging markets. And international reserves hit a 2-year high. And that's where the good news is. Now we start with the bad news. We see that private capital inflows subdued, foreign direct investment declined. And this just went to show decreasing investor confidence in Kenya. Kenya earlier on went back to the markets, successfully rolled over its $2 billion Eurobond that was mature, which was almost an effort to try and show investors that they're able to take care of their fiscal needs and they're also able to honor their debt obligations. However, the country has a budget hole of $2.7 billion after they were forced to pull back the finance bill after deadly protests. And while revenue collection is decreasing, government expenditure is increasing, coupled with high debt servicing costs. The government has little to no money on social and development spending. And so these are some of the things that are leading to that softening growth that we're seeing.
And what's the expectation then for the Kenyan economy heading into the new year, Ondiro?
The World Bank says they're keeping their hopes moderate and the growth will be gradual over the next couple of years. If we look at Kenya's debt, it remains in high risk of debt distress. Domestic debt now accounts for 51% of the country's total debt stock. And it's a liability because if you look at the vulnerabilities of this, the yields are high, the maturing periods are declining. And if we just stay with the local lending market, you see money going to the private sector is reducing, which is shrinking the growth of that sector because one, interest rates are high and they're being crowded out by the government. So the World Bank says that the country needs to address a couple of structural challenges in order to accelerate their growth and also address challenges such as unemployment in the economy.